Ladies and gentlemen, good day and welcome to the Economic Laws Practice Conference Call on detailed analysis of certain proposals announced in the Union Budget 2016-2017. We have with us on the call today Mr. Rohan Shah, the Managing Partner, ELP. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. I would now like to hand the conference over to Mr. Rohan Shah. Thank you, and over to you, sir.
Thank you. And good morning to all of you who have joined us on this webinar, where we're going to go into the details of various issues which have come up in the budget. And we've already been receiving a series of calls from our clients in the context of their seeking clarification on these. The presentation today is in 3 parts. We'll talk of the impact on the budget in the context of the changes and impact it will have on litigation. We will also talk about the changes in the context of the CENVAT Credit rules. And there is then a sectoral analysis that will be presented by Nishant and some of our other partners. So let's dive straight into the presentation for the day. Firstly, the impact on pending and future tax litigation. As all of us are aware, there is a very substantial amount of litigation in relation to taxation which is already in the system. And that litigation is spread from the level of the assessment right up to the Supreme Court of India. And one of the key statistics that boggles the world is that if we see how much time our Supreme Court actually spends on tax cases, then last year that was 28% of all of the time that the Supreme Court sat, it dealt with tax cases. That's unprecedented anywhere else in the world. And the reason for so many matters traveling up to the Supreme Court is that the thresholds which have been set by the government in terms of preferring appeals is such that the government is almost appellant in every matter which goes against them. At the same time, the quantum of demands as against assessees is so large that they also cannot give up cases. The result of this is what is reflected at the bottom of your slide. Whether we see direct taxes, whether we see indirect taxes, as we can see, there are a plethora of cases which are effectively there pending either at the Supreme Court, High Court or the ITAT. If you took the number of cases and divided that by the strength of disposal of each of these forums, it is quite clear that the time that it is going to take to effectively deal with these matters is only going to multiply. If we see the current status at the level of the Supreme Court of the totality of cases pending, the highest amount of cases are the cases which have been pending for more than 3 years. Similarly, at the level of these tribunals also, the number of cases pending more than a year and number of cases pending beyond 3 years are the highest. Very clearly, therefore, the system is entirely clogged with tax disputes. From a government perspective, they estimate that almost 4 lakh crores of tax revenue is locked up in litigation before courts and appellate authorities. Enough of a concern for the finance minister himself to make a mention of this in his budget speech. While this is the number that the department is looking at and is causing them concern, obviously from the perspective of assessees also, this very large pendency is causing people to invest time, resource and money, many a time in the pursuit of defending what they believe is completely unsustainable. And in the period while this is still being disposed of, obviously companies are called upon to make different sorts of provisions, write different sorts of notes of accounts, make different disclosures to stakeholders. So all in all, we have a system which is so lethargic and so overburdened with litigation that something had to be done. In the pre-budget conversations, the Revenue Secretary identified the reduction of tax litigation as one of the primary areas of concern of the government. The government, in the Finance Bill 2016, has taken some important steps which will impact the landscape of tax litigation. And broadly, we can classify these as: there has been a change in the period of limitation in the context of indirect tax, and that is clearly not good news. Interest costs have been rationalized. The imposition of penalties, especially in direct tax, has been rationalized. Certain greater safeguards have been taken to protect assessees against the risk of arrest and prosecution. Some alternate schemes for resolution have come in, whether we call them schemes in the context of amnesty or whether we label them as alternate schemes or declaration schemes. Certainly, the government has promulgated more of these schemes, hoping to enthuse assessees. And the pre-deposit requirements, where in indirect taxes they brought in a statutory amount. We see a similar change, although not through the statutory route, in direct taxes. Hopefully this takes over a layer of litigation, but more importantly, there is a predictability in the context of what is required to be paid from any order which is an adverse order. Let's go in a little bit of detail on each of these issues. If we see the situation in terms of the limitation for the purposes of demands of indirect tax, even up until last year, we had a situation where in customs and excise, you could go back in cases where there was no fraud, collusion, etc., 12 months preceding the date of the issuance of the show cause notice, 12 months preceding what the statute calls the relevant date. In service tax, that period was 18 months. Why there should be an anomaly between the service tax and the customs and excise has never fully been explained, but it is an anomaly which existed and actually now has been enlarged. From the period that you therefore had of 18 months in service tax, that period is now expanded to 30 months. And in customs and excise, the period goes from 1 year effectively to 2 years. If we chronologically see the evolution of how this has occurred, then there is an early period where we effectively had a commonality of 6 months in the context of demands for customs, excise and service tax. Although the dates are not reconciled, the first phase was typified by this period of 6 months. Thereafter, you had changes, and those changes effectively came about in the context of customs in 2011, in the context of excise in 2000, in the context of service tax in 2002, where this period effectively moved to 1 year. So, if we see this, in customs it remained constant for 5 years, in excise for 16 years, in service tax for 10 years, and then in the context of the last set of changes, you had 1 year for the purposes of customs, 1 year for excise, and then 18 months in the context of service tax. Now you have a situation where that period is extended to 2 years for customs, 2 years for excise, and effectively 30 months for the purposes of service tax. Now, what are the issues that this raises? Previously, you had a very clear demarcation between such instances where there would have been an interpretational divergence or even a genuine mistake, and the period that you could go back was more limited, and it was a year. You then had the longer period of limitation, but which had some very important triggers. The longer period or the expanded period could only be resorted to if you essentially had elements of fraud, suppression, willful misstatement, and there was an intent to evade tax. The Supreme Court interpreted all of these parameters as parameters where a mala fide intention was necessary and required, although there are later judgments which take a slightly different view. But the threshold was high, and it is only if that threshold was met that effectively you could go from 1 year to 5 years. Also, in our practical experience, as we argued more and more matters where the longer period had been invoked, we found that almost in 90 to 95% of the cases where the longer period was invoked, unless there was genuine fraud, by and large the demands would be held at the appellate level to be time barred. And that, in a way, in certain cases also had a repercussion in terms of whether a penalty ought to be imposed or not if the mala fide intention necessary to invoke the longer period was missing. With the new changes now, what do we see? Even if you have no fraud, suppression, willful misstatement, etc., the exposure is now for a substantial period. And therefore, even if there is just a bona fide interpretational dispute, or if the department changes its mind in terms of a certain classification or a valuation issue, then to that extent the assessee's exposure effectively doubles. If we see how this will play out in a few scenarios, and we've taken 3 scenarios here. One, suppose you already had a pending show cause notice. Could the department now issue an addendum or corrigendum and try and invoke the longer period, namely the 30 months or the 24 months? Second, where the longer period applies to a pre-amendment default, if the show cause is issued post-amendment. So, assuming you are in a situation where the short payment or non-payment is in an earlier period, but the notice will now be issued after the point in time that the new provision actually comes into play, then to that extent will you now suffer a liability either for 2 years or 30 months depending upon the tax. Scenario C, in a situation where the tax demand is in a way dead, namely it is beyond the period of limitation, can this new provision revive that limitation and therefore subject you to a jeopardy which at this point in time you do not effectively have? If we see the law on issue, very clearly the Supreme Court in the Kalyamurthy case said that it is within the domain of the government to determine what is the period for which a demand can be retrospective. And while that is within the domain of the government, obviously like all issues where government exercises jurisdiction, the exercise of that jurisdiction cannot be arbitrary and cannot be perverse. The Supreme Court, of course, made a very important point, that the important exception to this sovereign right of the government is that a new provision cannot revive a demand which is already barred or take away an accrued vested right. So what is your accrued vested right? The day the demand is barred, you have an accrued vested right to protection against demand. So what the Supreme Court says is, a new provision cannot effectively impact or take away that particular vested right. The view taken by the Supreme Court in the Kalyamurthy case effectively was also reaffirmed in Uttam Steel and Electrophons. You find that in the context of pure tax recoveries, this was also something which the tribunals have upheld. Now, if we apply the entirety of the law to the 3 scenarios that we were talking about, 1, scenario A, the law does not empower, in the case a show cause is already issued, the issuance of an addendum or corrigendum to extend the period from the 1 year to 2 years or 30 months. Scenario B, if the infraction is prior in point of time, but the notice is issued after the new provision comes into play, then in terms of the law declared by Supreme Court, it should be a notice which would be sustainable and a demand which would be sustainable. Scenario 3, where a notice or a demand is already time barred, that cannot be revived through the process of the application of the new provisions. Now, there will be some amount of debate in terms of the fact that when you have such a provision, ought this provision only to apply in the context of infractions after the date that this particular provision comes into play. But that, in terms of the law of the Supreme Court, the scope for that debate may be limited other than on the principles of equity. But when you have a legislative change being made, the sort of purchase you might get from an argument of equity may well be limited. So the provision is here. It is intended to be retrospective, and subject to the safeguards that we've discussed, it will effectively be brought into play. If we see the practical impact of this, if you look at the factor of, let us say we move on a presumption that tax was unpaid in the period, let's say April 2012 to December 31st of December 2016. If you look at that particular tabular summary, given the new provisions, because the scope of the demand increases from a year to 2 years, to the extent, or let us say in the case of service tax, from the period of the 18 months to 30 months, to the extent that you had a 1 CR demand, the period of demand itself would stand inflated, and correspondingly the amount of demand would stand inflated. These are of course approximations and presumed figures we've taken, but clearly the amount of the demand itself will stand extended. Correspondingly, the interest will also stand extended, and correspondingly so will the imposition of penalty. So this change not only resonates in the context of the basic demand, but to the extent that the interest is computed as a function of basic demand, and to the extent that the penalty is also computed as a function of basic demand, you will have a threefold impact of this. Now, what is it that it really means from the perspective of a business? Certainly we are looking at times where even in the context of genuine errors or interpretational issues, the extent of your liability can go up. So to the extent that we have interpretational issues either facing an industry or interpretational issues in a situation where we may have gone and got an opinion from a professional, important that we look at it in the context of its treatment, in the context of the provision we've made, in the context of our recognition of what the ultimate liability effectively could be. Another interesting issue which sort of effectively comes up in the context of this is what happens in the context of a change in law, not through the legislative process, but what happens where a certain law is declared as in terms of it being a precedent. Now, in terms of that being a precedent, subject to the overarching principles of limitation, there again is something that you need to effectively be looking out for if it fits within the time frames that the provisions are trying to cover. If we see the basic philosophy of why you would have a situation of retrospective tax demands, even though there may have been a full disclosure and even though the government may have applied its mind, it stems essentially from the principle in terms of saying that there is no estoppel in matters of tax, which our Supreme Court has recognized in Dunlop and in numerous other cases. If there is no estoppel, then A, there is an opportunity to correct a mistake, and then there must be a consequence to the correction, so you are able to go back. Now, the ability to go back was effectively circumscribed into two baskets. If there was no fraud or any of those elements, then 1 year, and if there was fraud, then obviously a larger and more severe period of 5 years. There was therefore an equitable balance created between a restriction for your claim for refund or filing of the refund, where again you had a time limit, and correspondingly, if a mistake had to be corrected by the department, the equitable balance was that they also had a restriction in the period that they could go back. Now what we see is that equitable period, which was 1 year for a long period of time, why it is now necessary to change to 2 years or 30 months, there is no rationale whatsoever. Again, there has been no corresponding change in the refund provisions, because if these were equitable, then they should really have been mirror images of each other. But what we now find is that in a manner, there seems to be a realization in the government that a department does err. It is not only as a factor of fraud or suppression attributable to the assessee, and by expanding this period, really the assessee is placed at a disadvantage, and some might say that in a covert manner, this is a provision to support the inefficiency of the tax department. It's an ability for them to reach out, even if they just have merely a change of mind. And from that perspective, amongst the many good provisions that we will discuss today, this is the one provision that we feel has actually been negative from the perspective of the assessee, supports the department, and does create in the real time a potentially much higher exposure. One of the positive changes has been the reduction in the rates of interest. If we came to the amendments which were made by the Finance Bill where we went up to a 30% interest for delayed payments in service tax beyond 1 year, there was a lot of criticism when that provision came to effectively say that it was usurious, that it was almost as if the government was acting like a moneylender trying to extract its pound of flesh. Clearly that criticism has gone home. It has been taken on board. We've had previous periods, for example, between 2001 and 2002, where interest rate were 28%. Through the period, if we see chronologically, rates have oscillated. The 30% was clearly seen as penal and usurious, and what the government has done is responded to that. So your normal rate of interest will be 15%, But in a situation where service tax is recovered but not deposited, then in that singular instance, it will be 24%. So again, a positive change where what the industry was seeing as adverse, government has stepped forward to address. The situation, if we were to look at it practically, and that's exemplified in the tabular summary that we've done, if you have a long-ranging demand and within that you will get different points and periods depending upon the statutory rate of interest which is prescribed, and we've just tried to illustrate over here the factor that if it is a longer period, let's say a 5-year demand, and depending upon the actual periodicity, you could actually be in a range of rates going from 18% up to 24%, beyond to 30%, and then effectively down to 15%. And that's something that you will have to sort of look at. Of course, there is no interest on interest, so therefore there is no compounding in the context of that. But useful change, at the same point in time, a lot of management to do, because if you do have a demand for a larger period, which is 5 years, different rates at different points in time. And again, should the government not have a uniform, linear policy which is not oscillating from year to year? I think 15 is a fair rate given the bank rate. 15 is also a fair rate in comparison to the 30 we had. But whatever government does now, from the perspective of certainty, it would be good if it can hold it into the next at least few years. Penalties, and the fact that penalties can go up to 100% of the demand and in certain exceptional circumstances even higher. The whole situation in terms of the architecture of the imposition of penalty needed a change. Fortunately, some good changes in the context of the penal provisions. Relevant to the direct tax, Section 270A proposed to be introduced in substitution of 271. This provision will be applicable from assessment year 17-18, and you now have two clear baskets in terms of the imposition of penalty. One, a 50% penalty in terms of underreported incomes, and you will see that these are by and large situations which lack mala fide and where there may have been either an interpretational issue or a genuine omission without any mala fide. This will be at 50%. To the extent that there is misreporting, there will be an imposition of penalty at 200%, and these are obviously far more severe in terms of cases of misrepresentation, suppression, non-recording of investments, a clear failure to record certain receipts, the falsification of records. So you now have these two tranches which are sort of effectively there. And depending upon the tranche in which you fall, the job of your relevant officer is now really one of classification. Namely, do you fall in the 50% basket or do you fall in the 200% basket? In the context of underreported incomes, there has been certain jurisprudence, Reliance Petro for one, where underreported income shall not include where the assessee has provided a bona fide explanation. So like I said, even if there is an omission, but there is no mala fide, you will still go under the 50% of the new scheme. Where all of the conditions which are necessary are satisfied, you do have a situation where the AO's discretion now reduces significantly. You really have a move to trying and ensuring that, as opposed to what you had previously under 271, which was contingent on the satisfaction of the officer and therefore that had wide play, and the AO effectively had to use his discretion as long as he said that there were factors for his satisfaction in terms of the imposition, he could get away with an imposition of a higher penalty. Now that domain of discretion has been curtailed. Very clear yardsticks into when you will fall into 50, when you will fall into 200. It will not entirely eliminate the disputes, but certainly will work as a catalyst to substantially reduce the disputes. You also have, for the first time, by the introduction of 270AA, an empowerment to the AO in certain conditions and circumstances to grant an immunity from penalty and prosecution. The assessee needs to file an application in this behalf. and subject to the conditions of payment of tax and interest, because this is only a facilitation for penalty, subject to the factor that an appeal has not been preferred and that a penalty proceeding is not initiated for misreporting. This will give the AO the discretion to completely waive the penalty. It's a very significant move, and one hopes that the AOs respond to the faith which has been placed in them, because under this there can be a complete waiver from penalty. So the sting of not only a reputational issue but a penal imposition can actually be taken away. And the way it seems is that the AO has no discretion to say you don't qualify and therefore I will reject your application. If in fact you tick off the preconditions, including the preconditions that this is not a case of misreporting, then in such a situation the AO is actually obliged to come through with the waiver. So again, a almost unique provision, one which invests a lot of authority in the AO, but a very welcome step, and one just needs to see practically what sort of traction is obtained by the assessees in the context of this provision. In the context of prosecutions and arrests, there was a situation where, given what you had seen recently in the Make My Trip, etc., that there was effectively a huge outpouring in terms of what these provisions were and how they were effectively being handled. Now, if we see it in the context of indirect taxes, we've had a statement of law from the Supreme Court in the Om Prakash case, where it is said that offences under customs and excise were non-cognizable and therefore bailable. There is jurisprudence globally, particularly even in the EU, to say that ultimately taxation is only an economic issue and it should never impinge on life and liberty. Simply put, that taxation should never lead to a factor of either criminal prosecution or arrest. Now, as we saw the aftermath of the Om Prakash judgment, Supreme Court tried to neutralize it effectively. Therefore, you came to a situation where you were with a set of provisions saying if the tax involved is more than 50 lakhs, if the provision of service is without the issuance of an invoice, if the availment of CENVAT credit is without actual receipt of inputs, either goods or services, if you maintain false books of accounts, or there is a non-payment of the amount collected, all of these four were really a trigger for the purposes of a criminal prosecution and arrest. Over a period of time, some of these provisions have been misused. And as they have been misused, there has been a huge outcry. And most recently, in the context of Make My Trip, it appeared that a show cause notice also was not issued, but still there was an arrest. Now, the government has tried to take steps. Even last year on the 23rd of October 2015, they revised the amount of 50 lakhs to 1 crore, but we know in today's day and age and given volume of transactions, this is not a high enough threshold. Given all the criticism faced, two important changes in this budget. One, that the 1 crore threshold has been effectively taken up to 2 crores. And from having 4 potential triggers for the purposes of initiating this criminal prosecution and arrest, it is now down to 1, namely that if you have a situation where service tax is collected but effectively not deposited. So again, a welcome move, but I think you also need in some form or manner a administrative fix for this. You need to have a committee of very senior commissioners at a CBEC level, and you need to actually leave it to them to take a decision, because the moment you have an event of arrest, from the level of the individual, obviously it's a life and liberty issue and goes to the very core of the protection that they expect from government. For companies, it's a reputational issue. But from the perspective of the nation also, it is these sort of issues which make the headlines and in a way obscure all the other work that is being done by the government or by the tax department. It is this sort of a situation which actually feeds the theory of tax terrorism. So very important set of changes in the context of this. You have a series of dispute resolution schemes which have effectively been brought in. And let me just take a moment before I get to these dispute resolution schemes. If I talked about the penalties in the context of indirect tax, the situation was at various stages in the life of a proceeding, depending upon whether you paid the amount in investigation, whether you paid prior to show cause, post show cause, post the order in terms of the adjudication, you had certain facilitation where upon payment of the tax and the interest, you would be in a situation where 25% penalty was really the acceptable penalty. Now, you didn't have something similar in the context of the direct tax. And given the thrust to say that we want to reduce litigation and therefore give people a chance to effectively resolve issues through a statutory mechanism, what you now see in the context of the direct tax disputes is that if there is a dispute and there are tax arrears and the issue is pending before the CITA, then given the window starting from 1st June where the outer limit will get specified, your appeal which is pending can actually be resolved in two ways. If the disputed tax is less than 10 lakhs, then the whole of the disputed tax and interest till date being within that limit, or if it is in excess of 10 lakhs. Now, to the extent that you pay the tax and the interest, you would get an immunity from the penalty where the demand is less than 10 lakhs. If the situation is that amount is more than 10 lakhs, then you would also have to pay a minimum of 25% of penalty. And in this manner, you can form a resolution. There is no further proceeding qua that particular assessment here and that issue. And in that manner, you can bring the entire matter to quietus. You will have a circle of immunity from prosecution and other sort of penal proceedings. If the proceeding was purely for penalty, then the facilitation is you pay 25% of the minimum penalty which is available, because often they invoke more than one provision. So you take the minimum penalty, pay 25% of that, and you can bring the matter to a quietus. In the context of the indirect tax, again, sort of a similar scheme, but slightly different mechanics. Here again, the situation is, if given the period in question, you could file the declaration within the window of declaration. As long as you pay the tax duty plus the interest and a 25% of the penalty, again you can bring the matter to a quietus. Now, the situation here is, some people have asked that in indirect tax I already had this sort of facilitation. So what is different? What is effectively different in the context of this is that earlier you could pay within that option depending on what time you paid, but effectively the proceedings could still go on. Here you now have a legislative imperative to say that moment you get into these schemes, the relevant litigation for relevant issue and relevant period comes to an end, and therefore this situation of litigation is no longer permeating through the pendency. Again, in terms of which are the situations where the scheme will not be applicable, cases, if we see direct tax where there is already a prosecution initiated, because please do understand, prosecution can now be initiated simultaneous with the civil dispute. Previously, the law of the land in terms of Supreme Court judgment was first finish the civil dispute, then initiate the criminal. The recent trend is that both of them can effectively be contemporaneous. Cases relating to undisclosed foreign assets, you can't go for the settlement. Cases involving search and survey. Cases initiated based on information which has been received under the DTAA. So if there are agreements under 90 or 90A, then you cannot take this facility. Or you are involved in legislations involving other economic offences, money laundering, etc. Likewise, certain situations where you can't effectively initiate this in the context of indirect taxes. The fact is that, where you look at issues, such schemes in the past, whether it is the black money scheme, whether it is this new avatar of the black money scheme, whether which is now for the domestic participants, all of these have not been enthusiastically subscribed to, including the VDIS or the Kar Vivad. because of the factor that normally the amount of tax itself is so significant and the related interest cost is so significant that merely getting a facilitation on penalty is not interesting. It is also a situation where larger demands, people do always feel they have an arguable case, whether it is on merits, whether it's on limitation. So how much subscription something like this will get remains to be seen, but it's a step to try and create a dispute resolution mechanism. And I think the government's focus on trying to do that is what is probably going to be more important as a matter of intent than in terms of the consequences or results or participation that they actually get on this. You then have the situation, again, when we talk of these schemes, that what you have is a facilitation in terms of a tax arrear. And once the declaration is deemed to have withdrawn the appeal pending before the CTIA, the moment they get into the scheme. So, does this in a way offer you immunity, or does it effectively resolve all your issues for different periods emanating or related to that particular issue? The bottom line effectively is the provisions of 204 of the Finance Bill say that this is not going to give you immunity in proceedings other than those in relation to which the declaration has been made. So therefore other proceedings, including for other years, do continue to remain open, and they will effectively still be conducted unless you are in a position to also file a declaration for dispute resolution in the context of those. The situation again, as we said on indirect tax, what is different? You have different stages. You could pay during investigation, when you will then voluntarily pay the tax. There's no question of penalty. Prior to the issuance of the show cause notice, where you will pay the tax and interest but no penalty. Within 30 days of issuance, again no penalty. And post, where you will pay 25%. Now, the situation here is you retain the ability to make payment of the amount confirmed but can still litigate further. And as I mentioned earlier, if you do go into the new dispute resolution scheme, that opportunity to go further disappears and the matter then finally comes to a rest. This particular scheme is different from your Section 73, where you will face a demand proceeding because there is a closure and the scheme is available for sort of a limited period of time. Now, in the current scenario, you will effectively continue to litigate. You will say that my payment is without prejudice. You can continue to test the legal issues, and at some stage, if you succeed in appeal, then you are in a position effectively to enjoy the fruits of that. Dispute resolution scheme tries not to foster further proceedings and actually kills those proceedings. Come next to what I think popularly is now being called the Vodafone provision. Obviously, the infamy that has come from the Vodafone case and which has hung around for India for the last 6 years has caused the department to want to do something. The issue is not easy. It's an act of a previous government sanctified by legislature. In certain cases, both Vodafone and Kane, they have initiated an international treaty arbitration, and in deference to the process, we have to participate as a nation. And therefore, the issue was, should they do something, and if so, what should they do? What they've chosen to do is to say that in a case which involves a specified tax, which is in turn defined to mean a tax determined as a consequence of a amendment which has a retrospective effect, then in that sort of a situation, there is a facilitation available to do a series of things. A, make a payment of the tax along with the interest. You do that and effectively they will give you a situation, there is a facilitation only to pay the tax. The interest and the penalty effectively go out of the equation. The moment you do get into this scheme, the situation then is that all proceedings of any nature pending anywhere effectively come to an end and are deemed to have been withdrawn. Now, while this particular scheme comes in, the one situation which comes up is that given the pendency of this issue for such a long period of time, has the government actually done enough? And the trouble is effectively twofold. One, when you say pay the tax, and the tax runs into the thousands of crores and therefore the billions of dollars, is it actually attractive to say pay the tax, and having paid the tax, I will look to waive the interest and the penalty? Because the tax itself is so large that the issue is that it will not be attractive. Second, to the extent that we see these cases, and maybe Vodafone is a situation where no tax would have been paid anywhere in the world. So you could say it was sort of a double or even a triple non-taxation. But in other cases, and you have almost another 140 odd cases, many of which are covered under treaty, where clearly India does not have the taxing jurisdiction. In many cases, there are also rulings to this effect. This obviously then does not become attractive, because where the basic tax demand itself is suspect, and you also have situations where the retrospectivity itself is in challenge before certain high courts. What sort of subscription we will get for this is doubtful. But I think the underlying message on this is even more troublesome, which is that while at the one end this government continually says that it is not a supporter of retrospective amendments, it is not somebody who is going to make a retrospective amendment. The moment your scheme of resolution says pay the tax, to the rest of the world, directly or indirectly, you are endorsing the retrospective amendment in terms of asking for a tax payment. And to the extent that that does not help us walk away from saying that we as a nation committed what appears to be an error, and we have not taken definitive steps to address that, unfortunately, although a step has been taken, this issue will continue to linger. You have seen other measures to reduce litigation, 11 more benches for the CESTAT. The Allahabad High Court very recently came down with an iron hand on the Ministry of Finance, saying they have not set up the regular benches of the CESTAT at Allahabad, which they should have. There is, of course, at the CESTAT a high level of pendency. All of us who practice in the CESTAT or go to the CESTAT as litigants know that the biggest challenge is not with this announcement. The biggest challenge is in finding enough quality members to tenant the benches. Because as we see, even in the current benches, there are gaping holes in terms of the benches. They are not operating at full strength. So, laudable measure, but clearly from our perspective, the practical aspect of finding quality members is going to be a key. The other situation is, you have changes in the jurisdiction of the single member. What used to be 15 lakhs has been enhanced to 50 lakhs. So therefore, hopefully more of these cases can now be dealt with. And in a way, given the paucity of members, at least it allows you to clear a certain lower section monetarily of the disputes that you have. So again, a welcome move. One of the key issues which has changed is this whole requirement on the pre-deposit. As we know, last year, in the context of indirect taxes, you got a provision of law. So statutorily, there was a mandate. Pay 7.5 in the case of the first appellate stage and 10 in the case of the second. And then you had an overarching ceiling in terms of the 10 crores. Now, in the context of income tax, the provision is now introduced, not in the context of a statutory provision, but effectively through an instruction. And here, the mandate is one where 15% is effectively fixed as a limit. But that 15% being fixed as a limit, there is, of course, discretion still vested in the AO. If the AO feels that there should be a variation to 15%, either that more should be paid because there are definitive cases supporting the view of the department, or less should be paid because there are definitive cases supporting the view of the assessee, then there is a discretion which is vested. But given that 15 is in a way a prudential norm, it is what the department is asked to look at. One is hoping that that 15% should suffice and there will not be too much tinkering or not be too much exercise of the jurisdiction that the AO has to, especially to up this amount. Obviously, if he lowers this amount, that would be pretty welcome. As we know, currently that yardstick of payment was 50%. The fact that it will now come down to 15 is welcome. And most of us have experiences of clients spending time between Jan and March, running between the CITA, Chief Commissioner, Principal Commissioner, AO, trying to get the pre-deposit reduced. Hopefully, this is something which is going to positively impact in the context of that. As we wind up on the issue of litigation, welcome as it is that the government has a focus and thrust on this issue, let's look at certain home truths which are still unaddressed. All tax proceedings are essentially Caesar to Caesar, namely the person who authors the investigation and the show cause also effectively will determine the issue. Either it's the same officer or it is a colleague of his in the same department. Until this tendency doesn't go, we effectively do have a problem. Second, very interesting statistic, at the adjudication level, 99% and more of tax demands are confirmed. At the appellate level, 86% of all revenue orders are set aside. What this shows you is that there is a huge artificiality in the system. What is confirmed in 99 cases out of 100 at the lower level, as it goes higher, only 13 to 14% of those cases sustain. Therefore, the rest of the litigation is in a manner almost an idle exercise. The third issue which is critical, we adopt global laws, whether it is customs valuation, whether it is transfer pricing, but we give them an Indian interpretation. As a client put it, the Indian tadka to the interpretation of global laws is always going to cause problems because you have a clear divergence in approach with the rest of the world. The Indian Supreme Court, as I said in the beginning, deals with more cases than the Supreme Court of the world's 50 largest economies combined. When we ask for pre-deposits, including pre-deposits which are mandated, 15% in indirect taxes, now what we are getting in direct taxes, the question is, are we monetizing bad orders and creating a surrogate financing system for the government? Ultimately, it will have to give it back, but are we not premiumizing these orders by mandating pre-deposits? Given the abysmal record of success in appeal, is there any justification for arrest and coercive recoveries? We at ELP have had situations where clients were unfortunately arrested. When the matters went to the tribunal and beyond, there were thumping orders on merits in favor of the assessee. How can you then justify the loss of reputation or the loss of the life and liberty issues of individuals? It's clear that besides the factor of what we've already done, we need to make many more substantial changes. One, at a very early stage, we need a distinction between issues which are purely interpretational and issues which are of evasion. That you wield a stick in a case of evasion is completely justified, but that you treat all interpretational cases as evasion is certainly not the way forward. Very clearly, we also need, more than what we've got today, situations where we have alternate and, in certain cases, innovative methods of settlement of dispute. World over, you can sit across the table from your tax officer and effectively convince him that you should pay a lesser tax. If we see all of our dispute resolution schemes, they are premised on the factor pay tax and then I will give you benefit. But there is not a singular scheme which effectively says, let us address the heart of the issue. Is the tax payable or is a lesser tax payable? But I think till we don't bring about a confluence of all of these factors, we will continue to see a very, very high amount of litigation, and that is unfortunate in the context of what sort of track record we are building. And just again to end with something which one of our clients said very recently, when we tried to explain to him why something is pending in the Supreme Court for 6 years, in spite of his having a favorable order, and he said, I have now realized that doing tax litigation in India is trying to drink soup with a fork, because whatever little you get, actually more slips away. And with that, let me hand you over to my colleague and partner, Rohit Jain, who will discuss the new changes in the context of the CENVAT Credit rules.
Thank you, Ronbhai. Good morning to all. Clearly, the CENVAT Credit is something which has been a matter of dispute and debate for the last decade. There have been a lot of issues which have been raised by the department in terms of interpreting some of the provisions of the CENVAT Credit rules. This budget has seen a lot of rationalization in terms of the rules which have been interpreted adversely by the department. We have done the detailed analysis of that provisions, and let's take a look at those analysis. Clearly, there are broad 4 concepts of a CENVAT credit. Once you make the payment of duty on the sourcing of goods or the services, first concept comes an availment of a CENVAT credit. Then we get into the distribution of that credit, then reversal of a credit if you are into manufacture of dutiable and exempted goods, and then ultimately utilization of payment for the output liability. Clearly all of these four concepts have undergone the change in terms of these amendments which have now been proposed. First being in terms of the availment of a credit, that now the definition of capital goods has the specific inclusion in terms of the wagons, which is under chapter 860692, which have now been covered specifically as being the capital goods. But the issue which remains unaddressed, that what happens to the movement of wagons from inside and outside the factory, because what will happen that at the time of receipt the company may avail the credit, but what happens, it removes back outside the factory for the transportation and again comes back. What happens to the impact of that moment when wagons are received and again gone outside the factory? That issue still remain unaddressed. While the credit is in principle is available, what happens to that issue, we need to look at it. Then the second issue which is most important is the restriction which was there in the exclusion of the definition of capital goods, that the goods which are used in an office in the factory was not available as a credit. Now that restriction or that exclusion has been done away with, wherein you can avail the credit in terms of the goods which are used as an office equipment in the factory, because the primary condition is still not been dispensed with, that goods should be received in the factory to avail the credit. So the simple point is that if manufacturer receives the goods in the head office, which are office equipment, the credit will still not be available, because the primary condition is that goods should be received in the factory and then it needs to be used in or in relation to manufacture of goods. This is a welcome move, that the office in the factory and you buy a lot of office equipments, be it computers, servers and other related assets, one can take a credit of that excise duty paid on that. Then we have another amendment which is important, because now import of cargo is now liable to service tax, and the issue came up for the shipping lines that import is liable, the export is not liable. What happens to that? Now they should really proportionately reverse the credit or not. There they have specifically clarified and excluded from the definition of exempt service that outward transportation of goods to outside India will not be considered as exempted services, and potentially they will be entitled for the 100% CENVAT credit, and the restrictions provided under Rule 6 won't apply in their cases. Then in terms of the availment, the next amendment is qua the capital goods and treatment of those capital goods now being considered as inputs. Lot of industries buy a significant amount or significant quantity of goods which value below 10,000 rupees. So typically the telecom sector, with small assets have been bought at each site of their telephone services, or the IT companies buy a lot of equipments below 10,000. The issue came up, how do we treat that asset as 10,000, whether it, because it classified under 84 or 85, therefore technically or strict speaking it was considered as a capital goods in the context of CENVAT credit rules. Now it has now been amended. Goods which are falling below the value of 10,000 now will be considered as inputs as opposed to capital goods. One issue still remains, how do we determine the value of 10,000? 10,000 should be only the basic value, or 10,000 should be inclusive of VAT and excise duty which is paid on that. It appears ideally that it should be the basic value, because when it comes to the value as a concept, it is always gone back to the assessable value under the VAT or under the excise duty or for the purpose of excise duty. So it appears that value should be only the basic value, but that issue is still not clarified. Now what are the advantages of treating below 10,000 goods being as inputs? One, you can avail the credit at one go. Otherwise capital goods credit you can avail in 50% and 50%. Now you can avail that at one go in the first year of receipt itself. The second one, that you may not require to reverse the credit on removal after use, because we know that in terms of the capital goods, as such removal or capital goods removal after use with a depreciation, you'll are required to reverse the credit and pay. Whereas inputs, there are provision under the credit rules today requires you to reverse the credit only if you remove as such. There is no requirement under the law today that inputs which are removed after use, whether you need to reverse the credit. But that's still an interpretational issue, but that may be probably one of the advantage. When it comes to the disadvantages, clearly now it is being inputs, therefore if you are in the manufacture of dutiable and exempted goods, Rule 6 will apply and you'll have to proportionately reverse the credit. Now time limit of taking a credit of within 1 year is also now apply, because it applies to inputs while not applicable to capital goods, but it will now apply to inputs. You need to reverse the credit when you write off these goods. So if you write off for the purpose of accounting in the books of accounts either fully or partially, you will have to reverse the credit. And the last point is that many of the schemes which are provided that you are not entitled for a credit of inputs and input services, while claiming certain abatements for payment of service tax, while you will be entitled for capital goods credit, now this credit will be fall in the category of inputs and you are restricted to avail the credit. So this is very important amendment while the goods which are below 10,000 rupees. There has been new levy called infrastructure cess. This is applicable on the motor vehicles. It is 4% and depending upon the category either 4 or 2 or 1% of the infrastructure cess. In terms of the budget speech and the TRU letter, it is clarified that infrastructure cess will be available as a credit. But if you look at it, will not be available as a credit. However, kindly note that any which way the duties which are paid on the motor vehicle are not available as a credit except for the service provider, though those are into the transportation of goods or passenger category. Clearly this infrastructure cess will not have a negative impact except the cost of buying the vehicle have gone up. But anyway, the basic duty itself was not available as a credit to the most of the SSEs except to the transporter service provider. Then we have a new cess which is imposed, which is Krishi Kalyan cess at the rate of 0.5% on all the services. While in again a budget speech and the TRU letter, it is made clear that credit will be available to KKC. However, the enabling provisions are still awaited because KKC will be effective only on the enactment on the 1st June of 2016. Therefore, CENVAT credit rules will get amended by that once this gets enacted. However, the most important thing are threefold. One, whether credit will be available to a manufacturer. It appears it should be available, but whether we'll have to wait and watch in terms of the enabling provision. Second, even if the credit is available to the manufacturer, where will they apply that credit? Because if they as a manufacturer, they are not required to pay any Krishi Kalyan cess because they are paying excise duty. So they cannot apply that credit. Even though it is available technically, this may not be utilizable and therefore again it may become cost. And the third important aspect, that manufacturers who are into the export of goods, can they claim refund under Rule 5? Because the entire credit availed can be claimed under refund under Rule 5 to the extent of export under bond. So the three important things for the manufacturer. One, whether credit itself will be available or not. If it is available, what are the avenues for utilization of that credit? But the more importantly, at least to the extent of export, whether that credit will be refunded when it is exported or to the extent of export under bond. Very important amendments to watch for, and that will come through closer to the date of implementation of this cess. Next important amendment is in terms of the jigs and fixtures and molds. It was always available as a credit when you supply to your job worker. The way the language has been, there have been dispute that first you need to receive at the OEM and then supply to your job worker, and then job worker can take a credit, and it is not requirement to receive those bags within 180 days. The practical difficulties have been faced by many of the OEMs because the physically goods were required to brought to their factory and then sent it to job worker. Now this have been amended, where now jigs, fixtures, molds can directly go to the job worker and still manufacturer can avail the credit. So the physical movement of goods to the OEM's factory is no more requirement. Then we have most important provision in terms of the assignment of right to use any natural resources. We have got the specific declared service in terms of the spectrum rights or in terms of the radio frequency rights, where it has now been considered as a service and now liable to service tax. But when it comes to the credit one, it has not been restricted only to the spectrum rights or the radio frequency rights. The language is assignment of any natural resources. And if you look at it, natural resources, it could come into any in terms of the mining rights, the timber rights, the oil exploration rights, the water or wildlife. So any of these natural resources which have been assigned by the government to any of the entity will be considered as a service and potentially may be liable to service tax. But when it comes to the credit is not available as upfront. You may need to avail the credit over the period of time till the time of the period of the assignment. So first time we are seeing that something concept like a capital service getting evolved, because we had the concept of inputs and capital goods, but when it comes to the services, we only had a concept of input services. The first time we are seeing that the concept of capital service of this nature is getting evolved, where the credit is available over the period of time and not one go. Can we say that this is the first step of evolution of capital service, and next year we may see further amendments in terms of more and more services are getting clubbed under this category, where the service tax credit is not available upfront in year one and it will be available over the period of time. Then we have another important amendment called the input service distributor. Typically, in terms of the erstwhile provisions, the credit could be distributed to the units of the manufacturer itself. So we have a situation where we have various job workers, the contract manufacturers. While you take a goods manufactured from them, then you do some further processing and supply and payment of excise duty. Or the job worker directly pays the excise duty either under Rule 10A or under Section 4A on the basis of MRP, and you couldn't distribute the credit to their units, and you could only distribute to the units of your own factory. Now the issue has now been amended, where in terms of the definition of input service distributor, you are now allowed to distribute the credit to the job worker or the contract manufacturer unit. One important amendment, this amendment is effective only from 1st April 2016. Therefore, services availed post 1st April 2016 can only be distributed to the job worker and outsourced manufacturer. Now, there are various situations that one needs to really look at it. The most important being that there has been no corresponding change in the definition of input service. So, take an example, a FMCG company gets all of their products manufactured through a job worker or a contract manufacturer. Or a FMCG company gets a particular set of products manufactured from the job worker, and the other products are only manufactured by them. Now they have a specific service which have been taken for the activity which have been done by the job worker. So the product X and product Y. Assuming product X is manufactured by the job worker, and you avail a certain services only for product X. Now in the hands of the FMCG company or a brand owner, whether it will be considered as input service in the first place. Because input service definition requires you to have used or in relation to manufacture, or used by the manufacturer for in relation to the activity of manufacture, or used by a provider of output service. And we have a third part of a definition which is wider enough to have a language such as advertisement and sales promotion. Can we read into a definition of input service to say that advertisement and sales promotion, as long as it is used by any entity, qua that product it will be available as a credit, or again that also needs to be used by the manufacturer. So the issue is likely to come up that at the outset itself whether this will be an input service or not. Assuming then it's an input service, then only you will have a facilitation to distribute as an input service distributor to the factory of the job worker or the contract manufacturer. So while it has taken a good one step forward in terms of providing under the ISD the facilitation to distribute the credit, but not amending the definition of input service correspondingly may still raise an issue, may potentially create a problem, and this the issue which is currently being faced by many of the FMCG pharma companies will still remain unaddressed to the extent of goods which are not manufactured by them and only manufactured by the job worker or the contract manufacturer. This is a big interpretational issue that one needs to still detail into and then take a final view. Another important aspect which is in the ISD definition, that Rule 6 of reversal of the restrictions is now not required to be applied at the ISD level. You will have to apply at the level of the unit itself or the manufacturing. We have put that hypothetical example here, that assuming taxable turnover is unit 1 is 1000, exempt is 2000, total 3000. Unit 2 is 5000, 2000 and total 7000. In the old position, if you would have done the Rule 6 calculation at the ISD level, you could have distributed to unit 1 18 rupees credit and distributed to unit 2 42 rupees credit. Total distribution would have been only 60. But under the revised formula now, because you don't need to apply Rule 6 restriction at the ISD, you need to carry out that exercise at the unit level. You will still continue, you will distribute 30 and 70 to unit 1 and unit 2 And at unit 1, you will do the calculation of rule 6 and the credit will be available as 10 and 50 at unit 1 and unit 2 respectively. So if you look at it, while the total credit remains same at 60 rupees, the unit 1 which was otherwise getting 18 now will get 10 rupees credit. In unit 2 which was getting 42 will now be available as 50 rupees as a credit. So while this is a very important clarificatory amendment to that extent, because there have been disputes which are going on that should I need to apply rule 6 reversal formula at the ISD level or do I need to go at the unit level. Next important amendment qua the input credit distribution is that now a common warehouse which is as the raw material stage. We have a warehouse concept at the final product stage. In the context of raw material, where you have a common storage facility, where you could buy the raw material for different units, and then how will you transfer that credit to the unit when the goods go. Now they have introduced the concept at a raw material stage, a first stage dealer concept, so you can apply as a first stage dealer as our warehousing registration and raise your invoice of a CENVAT creditable invoice from your warehouse to you on your unit, so that unit can avail the credit under this mechanism. Next very important amendment is in terms of the rule 6. We know that rule 6, there are various options which have been provided for the purpose of availment and thereafter a utilization of the credit. We have taken three scenarios which could be applicable. One, if the assessee is engaged only in the dutiable activity, full credit was available prior to the amendment, will continue to be available full credit, there is no change for those assessees. Assessees, those who are engaged in the exempted activity, again no credit was available, no credit will be available even after the amendment, no change. The significant changes have been made when the assessees, those who are engaged in the dutiable and exempted activities. And there have been a lot of rationalization which have been provided in terms of the rule 6 provisions. We have now tried to map what was the provisions pre the amendment and now what is the provisions post 1st April 2016. Okay, so for the period pre 1st April 2016, which is the erstwhile rule, the assessees, those who are engaged in the manufacture of dutiable and exempted goods. So I want to please focus on the left side of the screen or left side of the presentation. There was two options which was available. One is a separate accounts, or you have a common records you can maintain. If you have a separate accounts, credit which is exclusively for dutiable only available, otherwise no other credit not available. As a common records, you have two options provided. Option 1, you pay 6 or 7%, 6% for goods, 7% for services on the exempted value. Or option 2, where you put a proportionate credit. And proportionate credit again has a two option, that for inputs and input services both you apply proportionate formula, or option 2B, that for inputs you maintain separate records and for input services you apply the proportionate credit. Under this mechanism of a credit, there are potentially or there are mainly two issues which have been faced by most of the assessees. One, when I go for option 1 or option 2, under the common records theory, I was still not entitled for the credits of goods or services which are exclusively used for exempted activity. And that's a huge issue, because I end up paying 6 or 7%, I do proportionate of a credit, but when I do the proportionation of a credit, credits which are exclusively used for the exempted activity have been actually taken out first, and then the formula been applied. And the corollary of that is that the credit which are exclusively used for the taxable activity also remain part of the common pool, and you were required to apply the proportionate credit even for that. So there have been double edge or double whammy for the clients or for the assessee. One, first you pay 6 or 7% and you still don't take a credit of which is exclusively used for exempted activity. Second, when you calculate the proportionate credit, the common credit pool also includes the services or the goods which are exclusively taken for the taxable or dutiable activity. So it was a huge issue, lot of credit getting lost in the way of the working have been provided. Now what had happened under the amended rules? Under the amended rules, very important is that you have two options. Option 1, you pay 6 or 7% of the exempted value, and you can take the entire credit of all the excise duty, service tax, whether it is exclusively for common, exclusively for exempted, or exclusively for the taxable activity. Once you pay 6 or 7%, 6% for goods, 7% for services, you are entitled to 100% credit. You don't need to exclude what is exclusively used for exempted. Very important change. When it comes to the option 2, now you have 3 set of baskets or 3 set of buckets that you need to really maintain the details. 1, what is exclusively for exempted, don't take a credit. Then exclusively for dutiable, take a full credit. Thereafter what is left, which is common, then only you apply the proportionate credit formula. Very, very significant change in terms of the way the working has been provided under Rule 6. We have tried to put in terms of the number that how that will effectively change. Now assuming I have a 40% turnover of exempt and 60% dutiable. Now I have inputs and input services, which is exclusively to dutiable, I have take 50 and 20. Exclusivity exempted, I say 30 and 5. And I have a common inputs and services, which is 45. So total credit available or total taxes paid on sourcing, assuming is 150 rupees. Now what was happening under the erstwhile rule? That I could maintain separate accounts and take credit of only 70, which is exclusively to dutiable. That's the first column there. So I could take only 70 rupees as a credit. In the second scenario, which is I go for a common records and I then pay 6 or 7% of exempted. So 1000 rupees is exempted, so I pay 60 rupees. But I was still required to reverse the credit of this 35, which is exclusively for exempted. So effectively 70 plus 45, which I could take a credit, minus 60, which I needed to pay on the exempted value. So I was effectively getting the net credit of only rupees 55 when I go for 6 or 7% option. Under option 2, if I go for proportionate, similar way of working, I was getting only 69 credit or 83 rupees of a credit, because that 35, which is exclusively for exempted, was still an out of the taxable net and out of the credit net, while I pay 6% or proportionate credit. When it is now compared with the revised formula, once I pay 6 or 7%, that is 60 rupees on the output, that I can take entire 150 rupees as a credit, remove 60, then I am now entitled, instead of 55 under the old credit rules, now I am entitled for 90 rupees of a credit. You can imagine there is a 45 rupees of an increase in the credit, which is a very, very significant increase. Option 2, I can go for exclusive nil credit, full credit in terms of the what is exempt dutiable, which is 70, and out of 45 proportionate credit, it will come to 97. So what the way we have been working in the past prior to 1st April 2016 is now required to completely relook at it. That should we go for 6% option? Should we go for proportionate credit? What sort of credit I lose? What sort of credit now I will be entitled for? Very, very significant change. The last important change for Rule 6 is that there has been now added explanation to the exempted service definition, that the activity, and which I will read the explanation, which is first one, which is explanation 3, that for the purpose of this rule, exempted services as defined in clause E of Rule 2 shall include an activity which is not a service, or as defined in section 65B 44 of the Finance Act. Now can you imagine the scope of this new amendment, that activities which are not a per se service itself could now be considered as exempted services when it comes to Rule 6. So we have given a typical example, the transfer of right to use goods when you discharge VAT by transferring the possession and control will now be considered as exempted service, and you will have to proportionately calculate the credit. We have been thinking yesterday that what could be those examples, that transaction in money, you have the slum sale of business, which are excluded from the definition of a service, now suddenly become the activity of an exempted service, and you start calculating your credits based on treating this as exempt service. One very far-reaching impact is also for the works contract service. Now in terms of works contract service, you have a 40% or 60% abatement as the case may be. Now in terms of that, 40% you discharge service tax, and 60% you don't discharge service tax. Strictly speaking, qua that 60%, it is an activity which is excluded from the definition of service itself, because in terms of Article 366(29)(a) of the Act of Constitution, that is not liable to service tax, or not been considered as service. Can somebody will say that now therefore even in those cases you need to apply the proportionate credit to the extent of 40-60, and that will again throw up a huge number of issues qua the words contractor. So one needs to really do the detailed analysis of this very provision under Rule 6, that what is the scope of exempted services. Then we have some smaller procedural amendments that qua the capital goods, you will have to establish that these are used within the period of 2 years for the purpose of taxable activities. Then we have a no credit allowed which are used for beyond 2 years in terms of the capital goods. Then we have the procedural amendments apart from Rule 6, which are change that. Okay, in terms of the clearance by the service provider, you can transfer the credit. Last amendment is amendment in Rule 14, wherein we had last year, if you remember, the amendment under the Rule 14(2), wherein it has been deemed to be applied as FIFO basis for the purpose of utilization of a credit. So the option which was available with the SSE to avail the credit but not use, so that the issue gets settled, and the interpretational issue gets settled by the tribunal or the High Court, and then they start using the credit. Because it was again getting double hit. They can't take a credit at this stage, because if once they take a credit, it has been considered on a FIFO basis utilized. If they don't take a credit, the time limit of 1 year is actually running ahead. So what do they really do? Many of the assessees are into that dilemma. If I take a credit, I need to pay interest and penalty if I eventually lose. If I don't take a credit, even if I win eventually, I may not have option to take a credit because it is beyond 1 year period. Therefore, now this FIFO basis of application of a credit has now been omitted, and this is very important amendment, that the credit which are now likely to be disputed, or the credit which is of an interpretational nature, assessees may choose to take a credit, intimate to the department, wait for the final clearance from the department or the judicial precedent on that issue, and then start utilizing the credit. There will be still no interest and penalty of those credit availed, and you still protect your right to take a credit because you have availed within the 1 year period of time. This is in terms of all the CENVAT related amendments. Now I invite Nishant and our other partners to take us through all the sector wise impact in terms of the various sectors that we have identified. Thank you very much.
Thank you, Rohit. Thank you, Rohan bhai. So the budget has had a far-reaching impact on some of the specified sectors. And as Rohan bhai mentioned initially, that we've been getting calls from our clients on various issues which has cropped up under the budget. Identifying those queries, what we've done is identified a few sectors which are of critical importance and which have had a far-reaching impact. And we intend to analyze some of these sectors. The sectors which will be analyzed are automobiles, so the automobile sector, the real estate sector, then we have the gems and jewellery sector, which is another one. There is a transportation sector which has got impacted. Then garments has now again been brought into the tax net, so we are examining the ready-made garment sector. And finally, startups. There is an impetus which is being given to startups, which was under Startup India, an initiative of the current government, started earlier in this year. And certain tax provisions have been brought in to give an impetus to the startup sector. So let me introduce our team which will be analyzing the various sectors. To my right, I have Harsh. Harsh Shah will be taking up the real estate sector. I have Ranjit who will be analyzing the gems and jewellery sector. I have Gopal to my left. Gopal will be taking up the transportation sector, and Anay will be taking up the automotive sector. So with this, let me start off first with the to my far left, and let me start with Anay. Anay, on the automotive sector, there have been some significant changes in the automotive sector, and there have been changes specifically in relation to certain welcome moves, whereas certain not so welcome moves. So there have been new levies which have been introduced. The cost of the luxury car segment has been identified and been brought into ambit now. Whereas there have been certain CENVAT Credit related amendments also. So handing it over to Anay to take us through the analysis of this sector.
Yeah. As regards the automobile sector, my first comment in relation to levy of different cess.
Yeah.
Now, on the one hand, in the budget speech, where the finance minister recognized that, because of there is levy of different cess by different ministry, there is multiplicity of taxes resulting in cascading effect or increase in cascading effect. And he, in a way, abolished 13 cess which were prevailing. But at the same time, in indirect tax, there are two main cess that have been introduced. One is the infrastructure cess. One is the infrastructure cess, and the other is the Kalyan cess, which is there on service tax. Now, for the automobile sector, it is these two cess which are in a way resulting in having an impact on the cost of the goods of the automobile sector. The infrastructure cess is something which is specific for the automobile sector. It is a cess which is a duty of excise which will be levied and collected as a duty of excise, and it is levied on manufacture of certain motor vehicles. Now, the rate of the cess will range from 1% to 4% depending upon the length of the vehicle and the capacity of the engine. Where the length of the vehicle does not exceed 4 meters and the engine capacity is not exceeding 1200 cc, the rate is 1%. If it is a diesel vehicle, the rate is 2.5%, where the capacity mentioned is 1500 cc. For all other vehicles which are slightly larger vehicles, SUVs, etc., the rate goes as high to 4%. Now, an important point is that no credit of this cess will be available, and credit of any other duty which would be paid on the input side cannot be utilized for payment of this cess. Therefore, this results into a direct cost for the manufacturer of automobiles. As regards the Krishi Kalyan cess, like it was earlier mentioned, presently there is a credit of the cess. It was mentioned that the credit of the cess would not be available for utilization by the manufacturing industry. Now, automobile manufacturers therefore won't be able to utilize this cess to pay against any output liability, and therefore this would also add to the cost. As regards automobile manufacturers who engage job workers, from a CENVAT Credit perspective, there are two amendments. As was mentioned, in relation to taking credit of jigs, fixtures, mold, which earlier was required to be brought within the premises of OEM and then could be sent to a job worker. Now the provision allows it to be directly sent to the job worker. Also now, where there is a job worker engaged, credit can be distributed also under the input service distributor provision to the outsourced manufacturing unit, which would include a job worker. With the whole impetus on Make in India scheme, there was expectation that inverted duty structures as applicable in different industries, different sectors would be addressed or would be rectified. One of the issue was in relation to the automobile sector was there was a lower rate for tires which were coming in because of benefits or commitments under free trade agreements, but there was a higher rate in relation to the raw materials which were coming in, the raw rubber. It was expected that this could also get addressed, but this has not been addressed. This has remained unaddressed at this point in this budget. Another amendment has been in relation to the retail sales price scheme, where there are certain accessories which have been brought under the retail sales price regime. From an income tax perspective, one of the main amendment is this applicability of tax collection at source scheme to the motor vehicles being sold, where the value of the motor vehicle exceeds 10 lakh. So where a seller is selling a motor vehicle which value is more than 10 lakh, then he would, at the time of the sale, when he is receiving any money consideration from the buyer, he will have to receive additional 1% which he will have to deposit to the government. Now, an important factor is that in the budget speech and while this was introduced, the rationale given was this is in a way to bring within the tax net or the tax ambit or within the ambit of scrutiny and examination certain large assessees who would be buying vehicles which are exceed the value of 10 lakhs.
Right.
However, this is an amendment which is made to Section 206 of the Income Tax Act, and 206 defines a buyer, and the definition of buyer continues to exclude buyer who purchases the goods in the retail sale. So, although the amendment has been brought, the definition of buyer under that particular provision has at present not been modified, and we'll have to see if while passing of the finance bill whether this issue is taken into consideration and definition of buyer is rectified, so that the object as such would be achieved. So, to sum it, from a automobile sector perspective, two main important concepts, two new concepts. One is the infrastructure levy and the other is the tax collection at source scheme. So this is on the automobile sector.
Thank you, Anay. So, as Anay mentioned, that some welcome move for the automotive industry from the streamlining of the credit perspective, but at the same time, there have been new levies brought in, the infrastructure cess which comes in, the additional TCS, the tax collection at source at 1%, which comes in. And as Anay mentioned, there is this controversy of buyer definition not being changed. So is it that the levy will be at the stage of sale from manufacturer to the dealer stage and not from the dealer to the buyer stage, is what I think we look for the clarification as regards. Moving from the automotive sector to the next sector, that is real estate. And I will request Harsh, sitting to my right, to take us through the real estate sector. Harsh, on the real estate sector, we've seen some real welcome moves. And, of course, the government's structure also, they have brought in certain exemptions, etc. for low-cost housing, as well as certain clarity on certain controversial issues for ready-mix concrete and things. So, Harsh, we can take us through a detailed analysis of the real estate sector.
Sure. Largely positive moves on the real estate sector by introducing exemptions, promoting the low-cost housing, which has been one of the pioneer projects for this government. But there could be some unintended consequences, such as in the context of CENVAT Credit that we discussed earlier, in terms of whether a reversal will be required in the context of abated services as well. An important amendment to align with the industry practice is extending this exemption, which was in the context of concrete mix which is manufactured at site. We had an apex court decision in October of 2015 in the case of L&T, wherein the apex court essentially distinguished between a concrete mix and a ready mix concrete, very technical terms. The distinction essentially was made from the perspective of the manner in which a concrete mix is manufactured versus an RMC. Concrete mix manufacture being a fairly crude process vis-a-vis a sophisticated process for ready-mix concrete. Industry largely, and in a lot of real estate projects, typically the big ones, we see an RMC plant which is set up at site. And various industry players were claiming exemption under this very same entry. So the current amendment of extending a concrete mix at site to an RMC is a positive move. Certainly it will overcome the apex court decision. But with this move and with this notification, an issue that also parallelly arises is what happens to such RMC which was manufactured at the past. Are we possibly looking at a demand coming because of this welcome move, indicating that in the past such a transaction was subject to an excise duty? Also, a positive move is they've defined site for the first time under this notification, wherein they've said any premise which is being made available for the purpose of construction, specified in the contract, with the condition being the entire products manufactured qua that particular premise is used for the construction work. What an industry perspective is clearly to apply maybe section 11C to take care of the past period, wherein the government effectively has powers to exempt a levy of duty if largely it was an industry practice for not levying a duty on a certain transactions which are perceived to be non-taxable. Qua section 83 of the Finance Act, the provisions of 11C have been borrowed for service tax as well. Another important amendment that they've done is they've unified the abatement scheme now, which was leviable for the levy of service tax. Earlier we had a 25%, 30% amount on which tax was to be paid. depending on either a square feet or an amount which was essentially INR 1 crore. Now they've changed that 25 to 30, wherein in respect of all projects you will have to make a payment of service tax at 30% of the value. So essentially constructions in maybe tier 2, tier 3 cities, the service tax would effectively go up from a 25% value to a 30% value. An interesting and a supporting amendment has been proposed in terms of exempting dividend distribution tax in the context of business trusts such as REITs. This is one project where the government has been trying to boost. So there was an RBI circular also in November 15, effectively to support more foreign investments. What has been proposed now is the DDT that is payable by an SPV in which the business trust is the shareholder, that is proposed to be exempt. And now one critical condition is this exemption is only if the trust, which is an REIT, holds 100% of the share capital of the SPV. A small window to this is they've said either 100% or certain situations where the government decides it wants to hold certain shares. So the balance shareholding has to be by the REIT. As a contra to this, very interestingly, there's a non-obstant clause in section 115 BBDA which is proposed to be introduced, which says a resident individual HUF or a firm which earns dividend in excess of 10 lakhs is going to be subject to dividend distribution tax, or it's subject to tax at the rate of 10%. So while on one hand you sought to provide for an exemption from DDT to the REIT which has a pass-through status and therefore also to the investor, but at the same time there is a non-obstant clause and a new section which is proposed to be introduced. So there seems to be a bit of contradiction, and because of the non-obstant clause it seems that there will be a tax payable at the hands of assessees which are individuals or HUFs. Lastly, from a perspective of a few steps taken to promote housing related incentives, essentially low cost housings. So the exemption from service tax which was provided for low cost houses in terms of 60 square meters has been extended to additional schemes of the government. It was earlier available only to a particular scheme which was under the Ministry of Housing and Urban Development. A 100% deduction has been proposed in terms of Section 80 IBA of the Income Tax Act, wherein if an SAC is engaged in developing and building affordable houses which are approved by the competent authority. Now, a small difference in terms of service tax and income tax, when they proposed this 100% deduction, they bifurcated the areas between a metro and a non-metro to a 30 and a 60 square meter, whereas for service tax they've given a blanket exemption for 60 square meter irrespective of where this particular project is proposed or construction is proposed. Lastly, for first time buyers, as we've seen, there's an additional interest deduction of 50,000 per annum that is proposed. Effectively reduction in income tax by around 15,000 at the hand of an individual. So lots of steps taken in that direction to promote housing and a low cost housing essentially.
Thank you, Harsh. As Harsh highlighted, something to look out for the industry if they would like to go in for an 11C clarification as regards the RMC, because that had been the industry practice prior to this clarification coming about. And also certain positive moves by the government by giving certain incentives in relation to the low cost housing. So from there we move on to the next sector, which is transportation. I'll request Gopal to take us through the transportation sector. Gopal, on transportation sector, for the first time we've seen that the carriage of goods by ocean freight has been brought to tax. Now, India has been import dependent, and there has been this thing that import depends therefore on the carriage of goods by ocean as well as export. We are not to be brought to be taxed. Both these carriage of goods by ocean and by air have been removed from the negative list. One has not even come in the exemption list, but air has been in the exempt list. So that's an important change which has come in. Also in the transport sector, in the abatement also there have been a few changes. So I'll request Gopal to take us through the changes in detail, especially affecting the transport sector.
Yeah, thanks Nishant. As far as the transportation sector is considered, in all the form of transportation, be it by road, by air, by ocean, whether of goods, whether of passengers, there have been some or the other changes. In some cases, these changes have the far-reaching implications. And to start with, the transport of goods by vessel, and where there is a significant change which has come. It has turned down the entire position. So in respect of transport of goods by vessel from a place outside India to a custom station of clearance in India, so basically the inward movement of goods to India, earlier it was covered in the negative list, so no service tax was payable. Now that omission, that entry in the negative list has been omitted, and by virtue of this omission, this becomes taxable. And when it comes to making the payment of taxes, the government has prescribed an abatement of 70%, and so remaining 30% is taxable. And so if we consider 15% as service tax, which would be inclusive of base rate of 14% plus Swachh Bharat cess of 0.5 plus Krishi Kalyan cess of 0.5, so on 15%, this 30% would be applicable. So effective rate comes to close to 4.5%. So in respect of any inward movement of goods, to India on transportation of goods through by a vessel, the service tax is applicable. Now in this respect, one important aspect is that under the abatement scheme, so whosoever goes for the abatement scheme, the only credit which would be available to the logistic company or the transporting company, shipping line, would be in respect of input services. As far as input is considered, as far as capital goods is considered, no credit would be available. Now this particular change and this particular amendment in respect to the transportation of goods by vessel can have a far-reaching implications. The first important point is in respect of the duality of the taxes. Now, the freight is always considered as a component for the purpose of arriving at the assessable value in terms of Rule 10 of the custom valuations. So, whenever goods are imported, an importer has to make the payment of custom duty on the assessable value, which also includes freight as a component. Now, what would happen with this levy coming into picture? On the same freight component, it has to be added for the purpose of custom duty payment, and you need to make the payment of custom duty on the freight element, which remains as it is. But additionally, now one will have to also make the payment of service tax on this freight element. So on the same element, there are two levies which would be there into the picture. In this connection, one may have to look into the Supreme Court decision in case of United Shippers. United Shippers case, Supreme Court suggested that one has to look at the custom transaction and service transaction distinctly. What is forming the part of custom transaction should not form the part of service transaction, and what is forming part of the service transaction is something which is subsequent to the custom transaction. In a way, this particular amendment seeks to disturb the position or the finding which the Supreme Court had. Coming to the next, and as far as the manufacturing community is considered, as far as the service provider community is considered, those who are making the payment of taxes on the output side, one clear impact could be in relation to the accumulation of credit. Now what would happen? One will have to pay CVD of 12.5%, SAD of maybe 4%, close to 16.5%, and in addition to that, also the service tax payment in relation to the freight. So for this CVD of 12.5%, SAD of 4%, and then maybe service tax component could rise to maybe 1% or 2%. In a way, on the input side, there would be high amount of taxes which would be paid, though it would be available as a credit, but it definitely gives rise to the cash flow issue. And in relation to those manufacturers wherein those who are engaged in the exempted activity, no credit is at all available, and those who are engaged into the exempted as well as dutiable goods, in relation to those cases, it would be the proportionate credit which would be available. There would be impact in terms of the drawback rate, because currently the drawback rate what we have, that has not figured this particular element. So whether it would require any change or whether the government will make any change, that is something which needs to be seen. And one clarification which is there is that for the purpose of computation of custom duty, the service tax element will not be added. So one has to see that what would happen in terms of the import of goods. If it is FOB basis, then definitely it would be liable to both custom duty and the service tax, because in FOB basis, the freight is transportation is the responsibility of the importer. Whereas on CIF basis, it would be liable to only custom duty, because the transportation of goods is not at the end of the importer, but it is at the responsibility of foreign supplier, and in that case, it would not be taxable in India. For the trader community, definitely it would give rise to the additional cost, because whatever the service tax which is paid on the input side by any trader on import of any goods, no credit would be available. And it, surprisingly, unlike in relation to the goods, wherein a trader has the ability to pass on the credit on excise, on the CVD or SAD, in relation to the service tax, there is no enabling provisions in the Act whereby this particular service tax element can be transferred to the recipient of the goods. So this is something which is very critical. One has to look at that in terms of the costing, what implications it could have. Coming to the another leg of it, that the transport of goods by vessel or by the aircraft, one has to look at that in relation to the transport of goods by vessel from India to any place outside India. So effectively for the exports, one welcome change which is there in the CENVAT Credit rule, whereby they have amended the definition of the term exempted service, and it has the effect of saying that the transport of goods by vessel from India to a place outside India would not be construed as exempted service. Thereby, full credit would be available in respect to those transactions. So this is a welcome move. Previously, that creditability was not there; it was not permitted. In relation to the transport of goods by aircraft from outside India to India, it was earlier covered under the negative list. One interesting change, they have shifted it from the negative list to the exempted list, and now so it is no more part of the negative list. It continue to be exempted, but it may have implications. The implications would be in the form of credit restrictions which would be there on the input side, and in relation to the exports, definitely the place of provision of service would be outside India, so no tax, nothing like that. Coming to the transportation of rails and roads, there are few changes which are there. In relation to the Indian transport of goods services provided by the Indian Railways, the abatement percentage would be 70%. In respect of other service provider, the abatement rate would be 60%. One must note that earlier it was 60% for all the cases, and there would be the restriction in relation to the credit on the input services have been removed, has been done away with. In relation to the passenger, no restriction is there in respect of the credit on input services. When we consider the transport of goods by road, in relation to the GTA services, they are saying that if the GTA services have been availed for the movement of goods or the used household goods, then the abatement would be 60%. In all other cases, the abatement rate remains 70%. The payment under the reverse charge remains the same. There is no change thereon. In relation to the passenger movement by road, there is some change which is in relation to the movement through the stage carriage, and they are saying earlier the movement of passenger through stage carriage was part of the negative list, was not exempted, was not taxable. Now it is part of it has been omitted from the negative list, so it becomes taxable now. And if it is air conditioned movement, then it is taxable. If it is non-air conditioned movement, there is an entry in mega exemption list which takes care of it, and no tax is payable. Coming to the last leg of it, transportation of passenger by ropeway, there is an exemption with regard to this particular services, which was earlier available. Now it has been withdrawn. So these are all the changes which are there in the transport sector. Each particular form of transportation, there have been some or the other changes, but there are certain implications in some of the cases.
Thank you, Gopal. So, as we see that even though a new levy, even though the inward movement of goods by ocean freight has been brought to tax, there are a lot of issues which need to be clarified, and whether there will be a duality of tax, there will be a tax on it because freight is already covered in your goods and customs is being levied on that. So, a number of issues highlighted by Gopal, and I think there is food for thought for the government to think and come out with clarification on those. In the meantime, we move on to the next sector, that is the gems and jewelry sector, and I'll request Ranjit sitting to my right to take us through the gems and jewelry sector with a detailed analysis. Ranjit, the gems and jewelry sector has been brought into the tax net. Clearly, it's a move to expand the tax base with the view from GST also. But this sector has always been a little special sector because of the goods that they deal with, the nuances that this industry has. So what does your analysis say about the gems and jewelry sector from a tax perspective?
Thanks, Nishan. Yes, this sector is now burdened, and clearly it seems that the government is preparing for GST, and that's a small cue that I take from this amendment. Similarly, there is also the position that they want to increase the tax base, and it clearly seems this amendment is again oriented towards that. Because there is obviously a lot of consumption of these goods and articles, and India is in fact quite heavily importing these goods and articles. So the tax base is going up, GST is coming, and where is the burden going to be seen? The gems and jewelry sector. Let's look at exactly how they plan to do this, and in fact they've already done it. This is from 1st of March 2016. So all forms of jewelry will now suffer excise duty that will be excluding plain silver jewelry. Plain silver jewelry continues to be exempted. Now, there is an option in terms of the rate. The excise duty may be at 1% where there is no CENVAT credit availability. That option will in fact also have a further facilitation in terms of returns and in terms of record keeping. The other option that the manufacturer will have is the 12.5% payment of duty option, which comes with CENVAT credit and perhaps a slightly more burdened record keeping and return filing sort of system. But what is important is to understand how the value will be brought to tax and the threshold and the limits of turnover which will have to be seen. Couple of points which are of headline. One is that you need to monitor your value of home clearances on a year-on-year basis. Because as you monitor your year-on-year basis, you will decide whether there is a tax liability on your unit or not. We could look at the example which is brought out in that bullet on that slide, which says that if you look at year one, let us take a situation where the previous year we were at 11 crores of turnover and in the present year we are at 10 crores of turnover. What is the implication? Up to 6 crore we pay no excise duty. For the 4 crore remainder, we will have to pay the excise duty. You move to year 2, the previous year's turnover is 10 and the current year's turnover becomes 13. You still continue to enjoy an exemption up to 6 crores of rupees, and only 7 crores of rupees will have to suffer excise duty. We move to year 3, and this is where the exemption really plays itself out. You look at the previous year's turnover, which is 13 crores, and then you look at the current year's turnover, which is 10 crores. Since the previous year's turnover is more than 12 crores, the benefit of threshold doesn't apply, and the entirety of 10 crores will have to suffer the excise duty from the word go, and that's critical. So there is in fact a necessity for monitoring at all points of time year on year. Similarly, we can look at year 4, again you will come back to enjoying the threshold benefit, which is you will not pay on 6 crores and have to pay only on the 8 crores remainder. What does it mean for us as assessees and units go into this scheme is that monitor your threshold and monitor your turnover on a year-on-year basis, because you need to decide how and when you have to start paying your duties. Importantly, for the month of March of 2016, the value of 50 lakhs is where we have to start paying tax from, but only provided that the year previous did not have a turnover exceeding 12 crores. So, if we in the year ending 14-15 had a turnover in excess of 12 crores, in 50 lakhs, we will have to start paying from immediate effect. The benefit also has another sort of conditionality, which is when you go for the 12.5%, you have the benefit of CENVAT credit on inputs and capital goods, and there is also some ability to say that there is goods, capital goods which have been received in the previous year will also be available for credit. Importantly, for all assessees is that goods lying in stock, and this is going to be a critical question which will come up, is that if goods were lying in stock and they were in stock on the 29th of February, whether they are liable or not. The answer is yes. As long as they were manufactured and they were sitting in your stock, and when you clear them now onwards from 1st of March, any date thereafter, whichever scheme you may opt for, you will have to pay the excise duty on that and then remove the goods.
Okay.
Just looking at the practical side of things. One is, this is an excise duty, it's an indirect tax. Units will obviously have to pay it themselves, but there is always the ability to shift the burden of that to the consumer, which with most indirect taxes happens and will likely occur here. But what does it mean for units and manufacturers? As they go into this self-assessment mode, there are a couple of things that they'll need to do. Pick up an application file for registration. The government has clarified that it will be done in 2 days without a physical verification and a visit, that there will be a CA certificate required, that they will be satisfied with records that is maintained in any case for VAT purposes or for the Bureau of Indian Standard purposes, and in effect that the private records will suffice. And there is no cumbersome record keeping prescribed for this particular set of assessees. The other angle that has to be seen is that no declarations have to be made, though returns will have to be filed, they will be simplified, at least insofar as the 1% scheme option is concerned. Recognizing the sort of typicality of this sector, the government has appreciated and given one facilitation measure, and that is that there is a centralization registration possible if you have a centralized billing and record keeping system. Where would this arise? Because a lot of units or a lot of entities would have multiple units, and for that reason they would have the ability now to say that we will register ourselves centrally. The government is also conscious that small artisans and goldsmiths needn't have to comply, and so therefore the duty will always be payable by the principal manufacturer. Importantly, what does it mean in a very nutshell form of way is that all clearances will have to suffer duty from the 1st of March depending on your turnover for this year and the last year as well, and these will have to be in terms of an invoice, an excise invoice, which is issued in terms of the Rule 11 of the Central Excise Rules. There are therefore a certain set of ingredients that have to be mentioned in that invoice. The other side of it is that immediately assessees and units should seek their registration and make applications, and in the interim period where it is not granted and clearances are occurring, they may mention applied for, or they may mention that it's a provisional registration number if there is any granted to them in that manner. Just picking up on some areas for concern or possibly dispute. I wouldn't know which way to look at it, but there is some food for thought, as you would say. So the first one is that this industry is typified by removal of goods on consignment basis or on approval basis. So what does typically happen is goods are going back and forth. Now if I have paid the duty and have removed the goods, they have to come back. Now how will the valuation occur in that case if there is some work done and if there is no work done? So if you see that box in the middle of that slide, if you are in the 1% scheme and you have taken CENVAT credit, you cannot take CENVAT credit when the goods come back. Will I have to repay anything in terms of the goods being removed at the subsequent stage? No, because there is no manufacture presumably. But if there were, then there would be a double whammy, because as you've gotten the goods in, you've paid the 1% and you've cleared it at the first stage. Second stage, you brought it back in, no credit for you. As you do a rework or melting, etc., you need to pay the 1% again. So clearly, there is a double levy in that situation. On the other hand, if you are in the 12.5% scheme, you will be able to take credit of the duty that you paid when you cleared the goods. As you now clear the goods, even if you did not do any work of manufacture on them, you will have to repay the credit that you took. In the event that you have carried out manufacture thereon, there will obviously be the levy, which will be in the normal terms of the provisions of Central Excise Law. In relation to the factor again of where there are units and there is movement of goods from unit A to unit B of a centrally registered unit, and let's take a situation where there is an export also. Oftentimes goods move without the clarity as to whether they will ultimately be exported. Now, whether I will have to remove the goods from unit A to unit B, which are both centrally registered, without having paid the duty, that needs to be clarified. Having paid the duty, even if it were by the fact that I do not have the ability to decide as they are removed, whether they will ultimately be exported or not, and they're moved down to the other unit, then in that case, what is the facilitation which will be available to the unit which receives those goods and ultimately exports them? There is no clarity. Because otherwise we will lead to a situation of exports being made with duties and taxes loaded onto them. In a similar fashion where there is a non-centralized registration, if there is a movement, there is a clear position here which seems that again there will be an export of goods with the taxes and duties thereon. And that's something which the government should try and sort of take note and control of. Just moving on and winding this up on this sector is that if there is ability to take credit, these issues may not seem to be a problem where there is a BCD being increased on certain imitation jewelry, but more importantly in case of gold door bars and silver door, where the CVD has been increased. So all in all, there is a burden. This sector is clearly one of those which have been chosen to be burdened, and there is going to be some amount of onus on them from here on.
Thank you, Ranjit. So clearly, the gems and jewelry sector now being brought to tax. In fact, it just draws me that it also seems to move towards GST, because the Chief Economic Advisor's report, the report by Shri Arvind Subramaniam Committee, also says that the revenue neutral rate would be determined on how much is the burden that they bring about on the gems and jewelry sector. So maybe this is the starting point to finally go into the GST sector.
So they did say there is not much said about GST in this budget, but here's a cue that a lot has been done.
Sure. And also on the point, as Ranjit mentioned, that yes, the government though has brought in the 1% levy or the 12.5% with service tax, they have recognized certain nuances of the industry and therefore given facilitation of no visits because they deal with precious metals, records being maintained. For the first time under central excise, a centralized registration scheme being brought in is what we are seeing for the first time. Thank you, Ranjit. And moving on to the other two sectors which are of significance. The ready-made garment sector. The ready-made garment sector, the excise duty on this sector has been reintroduced. Earlier, the history has been that on ready-made garments, the excise duty used to be there for under an optional excise exemption scheme. Thereafter, in 2011-12, they brought in the excise duty with the two rates at 6%, which is without CENVAT credit, and at 10% at that time, which has now gone to 12.5% with CENVAT credit facility. However, looking into the structure of this industry and the unorganized part of the sector, which is prior to the final ready-made garments coming in, the duty was withdrawn. And I remember at that time that certain representations were made, and it was compared to a mobile phone which was at 2%, whereas garments were at 6% and 12.5%. So, one which is a necessity in the nature of kapda for roti kapda makan, it was brought at a higher rate. But now the levy has once again been brought in. The levy has been brought in at 2% with no CENVAT credit and at 12.5% with CENVAT credit facility. The levy covers garments which are covered under 61, 62, 63 chapter headings of the tariff chapters. However, only those which have an RSP of above 1,000 rupees and with bearing a brand name. Of course, the levy will be on a tariff value. Earlier also the tariff value has been there. There has been abatement which was earlier existing at 70%, which has now been brought down to 40%. So 60% of the RSP will be brought to tax under this levy. What is important is, let's understand the definition of brand name. The definition of brand name is pretty wide, and therefore any sort of monogram, symbol, mark, or even a signature or invented words on a piece of garment will be making it liable to excise duty and bringing it under the tax net. There is a consequential requirement to comply with the provisions relating to registration, etc., which comes as a burden on this industry. There is a facilitation provided because this industry also works in a manner that a lot of activities carried out by the job worker. The job worker may, and therefore here the brand owner will be considered as the primary person responsible for undertaking the registration and carrying out the formalities under the central excise law. However, he may authorize the job worker to register and carry out the formalities including the payment of duty. Goods produced before the implementation of this, which has been levied from 1st of March 2016, that is up to 29th of February 2016, and lying in stock, will now be brought to tax, and therefore the manufacturers who are eligible to claim CENVAT credit, that means who are agreeable to pay at a higher rate of duty, will be eligible for credit on the inputs contained in the work in progress of goods lying with them, as well as CENVAT credit on capital goods procured. As regards this levy which has been brought in, there seems to have been certain inconsistency in the approach of the government. They had initially brought in the levy, there was an option of exemption. Thereafter in 2002, again the levy was brought in, then the levy was withdrawn. Again in 2011, we saw the levy being brought in, again the levy being withdrawn. So what seems to be the thought process in bringing in the levy? Again, it seems to be a move towards GST. Clearly, the reports which have come in clearly mention that there is a need to widen the tax base, and this is one of the easiest manners in which the tax base can be widened. So that seems to move clearly towards GST. Certain other factors leading to an adverse impact for this industry is that it would result into, because this industry is quite fragmented, also decentralized, and also a lot of unorganized sector operating in this industry, there is bound to be some amount of cascading and accumulation of tax costs by the time the product reaches the final consumer. The 2% levy which is being brought in again will be a non-creditable levy, so that adds on to the cascading and the accumulation of tax cost. Finally, this industry has a peculiar aspect that, the ready-made garments at the end of the season are of very lower value as compared to their original RSP. And therefore, whether it's right to tax them even at 60% of their value, because at number of times, even the RSP is not completely realized under a sale season or a discount season. Recognizing this fact, the authorities have provided for an exemption up to 10% of the garments which are not finally sold and returned back to the manufacturer. However, is 10% an appropriate limit, or should they have kept it on an actual basis, or should they have created this facilitation where the sales actually also happen at a price lower than the RSP for a certain period of the season when it's the end of the season sale, etc. So these are some questions which are going to bother this industry, but clearly this industry is, like the gems and jewellery industry, being brought into the tax net, and will have to undergo the necessary formalities as well as bear the burden of the tax. Moving on to the last sector that we intend to analyze in today's analysis is in relation to the startups. This government earlier this year had announced a flagship scheme after the Make in India. This was the second flagship scheme of the Startup Action Plan, which was being brought in. And we had the DIPP issuing its notification sometime at the start of this year on the 16th of January, where it identified startups, and it notified that certain startups which would be working towards innovation, development, deployment or commercialization of new products, processes or services driven by technology or intellectual property. Clearly the focus being towards innovation, development, deployment, that is R&D, which is also featuring as part of the FM speech, and clearly driven by technology and intellectual property, as can be seen in the definition set out in the DIPP notification. Only those entities which are with a turnover of less than 25 crores in the previous years are to be covered. They'll be considered as startup for the first 5 years of their date of operation. Obviously, this entity should not have been formed by the splitting or reconstruction of an existing business or an existing entity. This have to be a fresh investment and a fresh operation to be started. And there was a need for obtaining the certification from the Interministerial Board of Certification to avail of tax benefit that the DIPP had clearly identified in their notification. Which takes us to the point that it was contemplated by the government when the DIPP notification came in that some tax benefits would be announced. And therefore, we had the Honorable Finance Minister in his budget speech announcing the profit-linked deduction under Section 80 IAC of the Income Tax Act, where he announced 100% deduction of profits and gains for an eligible startup unit. The deduction would be available for 3 consecutive financial years of the first 5 years of the operation of that entity, at the discretion of the entity, of course, and it would be for a company incorporated between April 1st, 2016 and April 1st, 2019. There are certain issues which come up reading onto these provisions relating to the beneficial provisions though announced under Section 80 IAC. One is that if it was clearly a beneficial provision, should there have been an exemption from MAT as well, because that has not been announced and clearly they continue to be burdened with the MAT provisions. The startups may not make profit in the initial years. There is bound to be a certain gestation period, and therefore obviously there will be accumulation of losses which can be set off. But how effective is this benefit which has been granted, considering that it is available for the 3 consecutive years in the top 5 years, and if a startup is not making any profit in the first 5 years, is it ineffective for that kind of a startup? Lastly, the DIPP notification very clearly says that the benefit is available to an entity. In fact, it goes on to define an entity to include a private limited company, a registered partnership firm and an LLP. However, when we read the provisions which have been introduced under the Income Tax Act under 80 ISC, it seems that they limit it to a company because they say it company incorporated, or is it that a company incorporated within this period but a firm, partnership and others which are already ongoing. Therefore, there seems to be a ambiguity, or there seems to be a duality in this aspect, that though the DIPP has a larger base of all entities, the relevant provisions under the Income Tax Act under Section 80 ISC intends to cover only companies, and therefore whether partnership firms, LLPs, etc. are not eligible for this benefit, are kept out of this benefit, is a question which again will come, the aspect of which will need to be clarified as time passes out. So these are some of the sectors we thought which were of critical importance for considering the budget, and the budget has had various implications. I thank the team for analyzing the same question. And with this, we conclude our today's session. Thank you very much for the participation. As regards any questions that our audience may have, they are always welcome. May we request our audience to please send us an email on the questions that they may have. It will be very happy to respond to the questions that we receive. And we look forward to you all joining in further webinars, etc. organized by ELP. Thank you very much.
Thank you.